I'm here to introduce Trevor. You've already heard from Trevor. So I'll just give you a little bit of background on how we got to know him. So we were on short notice, well, actually, we were asked or engaged by the Infrastructure Authority to do a study on basically a strategic analysis on what state revenues might look like with threats to coal. And at the time that this study was being commissioned, it was really just more of a market analysis. But then June 2nd hit and 111D came down, and so it's been kind of all 111D ever since. And Trevor's already shared with you some of the analysis that their group has done, Rhodium, and they've been gracious enough to help us along the way, because with our study, we did not have the resources in the short period of time we have to produce a report to actually do the sort of modeling that Trevor's group has done. And Trevor's group, Rhodium, really the important part of that is they are one of the few groups, as far as I know so far, still the only group that's really looked at the upstream effects of this regulation, which is really the more important part of it. Most of the EPA modeling and everything else you'll see, stuff coming out of the States, is really, it talks more about how many plants are going to be shut down, how many gigawatts of power this might take out of the market from coal, but they don't really look at the general impacts. And the Rhodium Group has the ability to model that. So very quickly, I learned about their research through an article in the New York Times. Called Trevor, and like a true Wyoming native, he was more than open to somebody out of the blue calling up and saying, would you mind sharing this important analysis with a state like Wyoming? And so we're really grateful for that. I got to know Trevor this summer a little bit, phone calls, and then we met up in Jackson to talk about some of the results. And one of the things that I realized really early on is that I'm really jealous of Trevor. I mean, first of all, he grew up in Jackson, which is pretty lucky. I didn't. I grew up in northern Ontario, where it's a lot snowier and cloudier. So I was already, that was one thing that I could, feel a little bit badly about myself on. But if you've read his bio, and I teach a lot of students, and I would point to a career like Trevor's as something that my students should aspire to. He's obviously worked really hard, but if you look at his career at City College, and then we talked a little bit, I asked him, so how did you get to where you are? And he told me about taking advantage of an internship, being able to go to China. And so what you're going to hear about next is really kind of the logical outcome of really just chasing an opportunity down, and it seems like really making the most of it. And it sounds like, I don't know Trevor that well, but to say that what I tell my students is look at something you're passionate about and work with it, run with it, do what you can. And so just look at the trajectory in the short bio there of Trevor's career, a partner with Rhodium Group now, all coming from these experiences he set himself up for, but then being able to go into public service. So he also served at the State Department, and you can read about some of the initiatives that he's helped set up, the shale gas initiative with China, the renewable energy initiative. So very important work. He hasn't just done it for himself, it's public service. And the final thing I'll just say, and to kind of lead up to his talk, it's not just about how much coal this reduces or how much gas this reduces, but if we're thinking about how we're going to use our resources in this state, one of the questions we've been asking is who might benefit from the resources in our state besides Wyoming or the United States. And obviously the state has been looking at markets like China, Asia, those areas as a potential place for us to increase the value of our resources. And one of the things that we invest a lot of time in as we think about energy policy or resource policy is what are the politics of a particular place. We all spend a lot of time trying to figure out what's going on in Washington and how is that going to determine the decision making. At each of these board meetings that I've been to anyway, we get a report on California. How is that going to affect our energy future? Because, being a small state, we're at the whims of the market. Well, similarly, if we're going to think about China and other countries, we need to understand their politics as well and what's going on. And the thing about China is very few of us really understand it. And so the value added that Trevor brings, that he's been working on through his career, as far as I can tell, is that he really does understand what's going on in China. And one of the things that I mentioned to Lloyd was I read one of the papers that he shared with me, and it was a unique perspective looking at what would happen with Chinese markets, or what potentially could happen with Chinese markets, not looking at what, profitable opportunities might be there, but actually looking at what is driving their potential use of coal and other energy sources. And from that was a perspective that I just hadn't read much about. And so that is what I think Trevor is going to talk about today. So with that, I will pass the floor over to Trevor, and I would really encourage those of you who haven't met Trevor yet to get a chance to know him and the analysis that he and his group does. It's really, they really do have a great resource for analysis, and Trevor has a unique perspective on things that most of us don't know a lot about, so it's important to find those things out. So with that, Trevor Houser.
Thanks, Rob. That was an incredibly embarrassing introduction. The problem of picking up the phone when a University of Wyoming professor calls you out of the blue to ask for you to share some modeling results is then he puts you on the phone with Lloyd Drain, and you go from sharing some modeling results to presenting them to giving a lunchtime keynote address. But it's a pleasure. So I'm going to try to be provocative, provide some lunchtime entertainment. This is, like they say in Monty Python, now for something completely different than what we were talking about in the last session. And what I want to do with the next 30 minutes is walk through some political and economic changes that are occurring in China and what it means for both Chinese energy markets and for global energy markets and potentially for the state. So if we kind of ground ourselves, thinking about where China is going in the future, we have to start by kind of understanding where China has come from. And since this is an energy crowd, I want to do that through an energy lens. So this is a chart of the energy intensity of the Chinese economy. So it's the amount of coal, oil, and gas required for each unit of economic output. So it's kind of like an EKG for the energy sector in China. And a rising line means the country is becoming more energy intensive, and a declining line means that it's becoming more energy efficient. And there's three inflections since the Communist Party took over in 1949 that are important to note. The first is in 1958, where Mao Zedong takes a country of farmers and decides that he doesn't want to pursue the labor-intensive light manufacturing strategy of economic development that Japan and Korea and Taiwan had done. He wants to leapfrog that and jump straight to the commanding heights of the economy, to the steel and heavy industry that characterized the Soviet Union. And so over the course of 10 years, Mao takes tens of millions of farmers off the farm into steel mills. It turns out that making steel is a lot more energy intensive than growing rice, and so the energy intensity of the Chinese economy triples between 1956 and 1978. By 1978, that strategy is completely bankrupt. China has a major famine during the beginning of the Great Leap Forward that kills 30 million people because there's not enough folks left on the farm to grow adequate amounts of food. By 1978, dreams of a industrialized China are not bearing fruit, and Deng Xiaoping decides to go another direction and start to take the hand off the tiller of the Chinese economy from a government standpoint and start to let markets work. The next 2 decades is what brings us the China that we know today, a gradual liberalization of prices in the economy, an increase in economic freedom, though not political freedom, that has profound impacts on the energy sector. So up until 1978, it's a completely planned economy. If you're a firm, you're told how much input you can buy and at what price, and you're told how much output you can sell and at what price. There's no profit margin, you're paid a flat salary, which means that there's no incentive for innovation or efficiency improvements. If you're a steel mill, you've got a fixed amount of iron ore that's coming in and met coal, and you have a fixed amount of steel that you're supposed to sell. And if you try to get creative about efficiency improvements, there's no monetary compensation to you as a manager for doing that. Over the 80s and 90s, that starts to change. Energy prices are slowly liberalized at the same time as state-owned enterprise managers are given a little bit more profit incentive for how they manage the business. So you see a significant improvement in technical efficiency. At the same time, individuals who previously have been told by the government what they could do for work and where they could work are begin to get some freedom to choose what type of career they want to pursue and where they want to invest. And what we see is a profound structural shift in the Chinese economy away from that heavy industry towards the labor-intensive light manufacturing that we know China for today. So those two things, technical efficiency improvement, structural adjustment in the economy, reduces the amount of energy required for each unit of Chinese economic output by 2/3 between 1978 and 2000. That's unprecedented anywhere in the world. It says more about just how distorted the Chinese economy was in 1978 than how efficient the Chinese economy was in 2000. Indeed, in 2000, each unit of economic output in China still took 5 or 6 times more energy than your average developed economy, including the US. And as a result, looking forward, planners, whether they were in Beijing or whether they were energy modelers like myself outside the country, or oil and gas companies planning investment, thought that China would be able to continue this trajectory for another 2 decades. And instead, we saw this little blip. And that doesn't really look like a lot on this chart, but when you combine that small increase in energy intensity with an economy that's growing at 10, 11, 12% a year, you get a significant revision both in Chinese demand and in the projections for demand going forward. So this is the International Energy Agency in Paris's forecast for Chinese energy consumption in 2002, 2006, and 2010. In a span of just 8 years, there was an 80% upward revision in the IEA's forecast for Chinese energy demand in 2030. So that's 2 Indias of today, or 1 India in 2030 is just a kind of rounding error in forecasts year to year. I am going to get that tattooed on my stomach as a constant dose of humility for those of us who try to forecast energy futures, to remember just how wrong we can be. What drove that change in the energy intensity of the economy was urbanization. Up until the late 1990s, the view, the view in Beijing is that urbanization could be a major source of political instability. Life is better in the city than it is on the farm. If you let people move from the farm to the city, they'll do so en masse, and there won't be enough people to grow rice, and you'll see another wave of starvation. So there's something called a hukou system, a domestic passport that restricts where you can live, where you can work, and where you can receive social benefits. By the late 1990s, attitudes about migration are starting to change. Leadership sees rural-to-urban migration as a source of economic strength rather than political instability, at the same time as China is integrating into the global economy, and there's demand for light manufacturing labor along the coast in coastal provinces. And so we see between the late 90s and the mid-2000s, 300 million Chinese urbanized, either because they pick up and move to the city or because they see cities built up around them and what used to be farmland. Largest migration in human history that occurred over the course of a decade and a half in one country. The accelerant on that urbanization push was widespread financial repression. So in the 80s and 90s, as all these households are getting relatively more affluent compared to where they came from, making socks and underwear and Barbie dolls for Walmart, they have 2 places to put their money. They can either put it under the mattress or they can put it in a state-owned bank. The Chinese economy is closed from a capital account standpoint, so you don't have the ability to send money out of the country. You can't invest it with Fidelity or BlackRock. You have to put it only in a Chinese state-owned bank. And those Chinese state-owned banks disproportionately lend to state-owned Chinese companies that underperform private sector companies, right? As a result, a lot of those loans go bad. To keep the bank solvent, to maintain the state bank's ability to lend to state-owned enterprises, you have to create a savings, a deposit and a lending rate spread that is large enough to offset your bad loans. What that meant is that in the 90s and the 2000s, average real returns for Chinese savers were negative. right? On average, Chinese households lost 1% of their principal each year for the money that they put into the bank. A multi-trillion-dollar appropriation of wealth from households that was given to state-owned Chinese enterprises, right? Those state-owned Chinese enterprises are disproportionately concentrated in energy-intensive sectors of the economy, like infrastructure and property and steel and cement manufacturing. And so what we saw was this dramatic growth in demand for steel, cement, aluminum, flat glass, really energy-intensive products, right? And even faster growth in investment in the production of those goods, so that China went from being the world's largest steel importer in 2002 to the world's largest steel exporter in 2006. And that's actually why China has a large global trade surplus today. Up until 2002, China ran balanced trade with the world. They ran a trade surplus with the US, but for all of the socks and underwear that China exported to Western markets, they imported as much natural resources, intermediate materials, and semiconductors from Taiwan, Japan, and South Korea. In the 2000s, early 2000s, import substitution in those energy-intensive materials is what blew up China's global trade surplus. It wasn't that they exported more socks and underwear than they did before, it's that they stopped buying a lot of the stuff that they used to buy from other countries. And the impact of that on the energy sector was profound. So when you go to Beijing or Shanghai and you see all these shiny new apartment buildings and highways clogged with vehicles, most people think that that's what drives Chinese energy consumption. It's this rising middle class, right? It's people turning on the lights and filling their cars. That is still almost a trivial share of Chinese energy consumption. 75% of Chinese energy demand today comes from industry. 50% comes from just 5 industries: steel, aluminum, flat glass, chemicals, and cement. The steel sector in China consumes more energy than all the households in the country combined. It is an investment-led energy picture. Now that's paving the way, it's building the highways and the apartment buildings for that Chinese middle class, and down the road, that'll be the driver of Chinese energy consumption. But today it's primarily heavy industry, fueled by cheap capital, appropriated from households who have no other options on where to put their money. Meeting all of that demand has required a lot of energy as a whole and increasingly electricity. So this is the change in capacity, power generation capacity nationwide by source each year since that surge in electricity demand began in 2002 to today. And at the peak, 85 gigawatts of coal-fired power added, declining slightly over the past few years. Last year, 43 gigawatts of coal capacity came online. A lot of hydro, a little bit of natural gas, and a fair amount of wind in recent years, but it's primarily been a coal-driven story that has increased coal prices in China. It's tightened Asian coal markets. It's also led to some fairly nasty air in Beijing and other places, as anyone who's been there knows. I worked at the US Embassy years ago, and I was sent to do all the things nobody else wanted to do, like go down coal mines in Inner Mongolia and traipse around oil and gas fields. And I had to write the air quality cable to Washington, which I thought was kind of a trivial assignment. It turns out it's the most closely watched cable leaving the embassy because it determines the hardship pay that US government employees get when they work at the embassy in Beijing. And at the time, it was a 25% hardship premium, which was as much as you earned if you worked in the green zone in Baghdad. So from the standpoint of the US government, breathing Beijing air was kind of comparable in risk to life and limb as working in Iraq. This is PM 2.5 pollution, which is the kind of major driver right now of public health costs in China. Small particulates that burrow into the capillaries of your lungs and do nasty things. PM 2.5 levels in China are 10, 20 times as high on average in northern Chinese cities as they are in most developed country cities. As Chinese citizens have gotten richer, as they begin to travel and they see what not Beijing air looks like, this has become an increasing source of political risk for leadership. If you have a democracy NGO that starts protesting in Tiananmen Square, you break that group up, you send the leaders to Xinjiang, they spend the rest of their lives breaking big rocks into small rocks, nobody ever hears from them again, out of sight, out of mind. It's pretty easy to control. Can't hide the air, right? It is this daily sign of central government impotence, and for middle-class Chinese, the thought is, how can all these other countries have reasonable air? We're now the second largest economy on Earth. Why can't our air be cleaner? So this has increasingly become a driver of policy in recent years. As early as 2005, central government leadership realized that that very investment-intensive strategy of economic growth was not sustainable, and that it wasn't paying dividends that they needed in terms of job creation. So what this chart maps for you is the amount of energy demand that results from 1 million renminbi of fixed asset investment versus, that's this axis, versus the amount of employment created by that renminbi, right? So if I'm gonna dump 1 million renminbi into the iron and steel sector, it will result in 40 times more energy demand and only 1/3 of the jobs as the same million renminbi put into the service sector, right? So those 5 industries that I mentioned earlier that account for half of China's energy consumption, they account for combined about 30 million jobs, right? That's less than the service sector just in Guangdong province alone. This is a labor market of 770 million people. So if you are short on energy resources, you have air quality problems, and you need to create jobs, dumping all your resources here is just the wrong way to go. So leadership has realized that. 2006, 2007, they started putting in place policies to try to rebalance the Chinese economy. So to shift investment from here to here, right? Because the service sector is very underdeveloped in China. One of the reasons it's underdeveloped is that if I'm a private service sector company, I can't compete for capital from the state-owned banks because of those distortions. So I have to go to the curb market, the shadow banking sector, and borrow at 35%, right? While state-owned firms can borrow at 5% nominal, right? Sometimes they can borrow at -% real. And that creates a very unlevel playing field between state-owned companies and private companies. Now that's a problem for long-term growth, not just because of the energy and environmental consequences and the employment consequences, but because the average state firm, this is some work the IMF did looking at the return on investment of a wholly state-owned firm versus the line is private firms, and that's private majority. Same 100 million of renminbi invested, delivers 35% lower real returns if a state firm is investing it versus a private company investing it, right? Now the upshot there is if you can change the finance system and you can redirect capital away from these guys to these guys, it's going to be welfare enhancing, right? If you give the capital to the people who can use it more productively. So that's what rebalancing is all about, and you hear this in the press. Xi Jinping, the president of China, is putting in place fairly aggressive economic reforms to try to move capital from these guys to these guys. The problem is, these companies are pretty politically powerful, right? The heads of state-owned enterprises have ministerial rank within the Communist Party. They have very well-established channels of lobbying up to leadership, and they're not so eager to be cut off from the methadone drip of cheap capital that they've been on for the past decade, so it can be put out the door to hair salons and restaurants, right? So this is the political challenge that Xi Jinping faces right now. The stakes from an economic standpoint are very high. China cannot continue to grow at 8, 9%, 10% a year. It's at that income level. And this chart is average annual GDP growth relative to per capita income, and it compares China to other countries when they were at the same point of development. So Chinese growth is going to slow. The question is, to use a ski metaphor since we're in Jackson, is does China take the bunny slope path down the mountain, which is slowly decelerating rates of growth, like Japan, Taiwan, and Korea, emerging on the other side an affluent economy? Or do they take the Mexico double black diamond path right into what's called the middle income trap, right? Economic growth for an emerging economy like China is not preordained. In the 70s, we had high hopes for Latin American economies, right? And many of those economies did not successfully make it through the economic reforms required to follow the pathway that Asian tigers did. And that's the challenge for China today. Can Xi Jinping, who is a pretty committed leader in terms of economic reform, can he tackle those vested interests and successfully redirect capital, right? All right, so let's talk about the energy sector consequences of it. Some of that rebalancing has already started to occur. So we've seen investment. This is the contribution to annual economic growth from investment, consumption, and net exports, right? So what you want to do is you want to boost this bar and drop that bar. That's how you make growth in China more sustainable. Less investment, more consumption, right? And we've seen investment growth slow and consumption growth hold up relatively well. That has dramatic impacts for the energy sector because that investment has been the driving force behind energy demand in China over the past few years. And you can see this in the power data. So if you look at year-on-year electricity demand growth, 2013, 2012, and 2011, for the past decade and a half, China's averaged anywhere between 10 and 15% annual growth in power demand, right? We started getting trick calls from commodities traders in 2012, early 2012, saying the GDP numbers we're hearing from Beijing are softer, but they're still pretty good, 7-8% growth. What we're feeling in the commodities market is an apocalypse. Like there's just no Chinese demand for these goods. What's going on? And the disconnect was, their view was that the government must be lying, the economy must be completely falling apart. What was happening was that engine of energy demand, industrial production, heavy industrial production, was starting to slow. So even though private service activity, residential consumption was holding up relatively well, industry accounts for 75% of electricity demand. So when industrial power demand tanks, it takes overall power demand down with it, right? If we think about this from a kind of coal market standpoint, for a moment, and what successful economic rebalancing could mean for coal consumption in China. Currently, this is share of total Chinese coal consumption. The most heavily consuming region is around the Beijing, Hebei, Tianjin region here, northeast China, where it's used both for power generation and for household heating. There's still like 150 million tons of coal in China consumed just for residential furnaces. It's those coal briquettes that they wheel around in wheelbarrows. It's shocking. The public health costs of that are dramatic. So that's where coal demand has been greatest in China in the past. That's also as a result with the air pollution is worse. And there are policies being put in place now to try to deliver absolute reductions in coal consumption in coastal provinces here. And to redirect investment away from the most coal-consuming economic activities in those coastal provinces. So the outlook for coal demand in these provinces is pretty bleak. Now, that's only part of China. There's a lot rest of China. And that drive for rebalancing the economy is running head-to-head against another economic priority, which is to develop the West. Right? So there's long been a major income disparity between coastal China and western China, and for long-term political stability, leadership would like to even that out a little bit. This is a map of hydrocarbon and coal resources, and the large coal basins are Inner Mongolia, Shanxi, Xinjiang, and those provinces have long looked for ways to get more, this is a story that'll be familiar in Wyoming, more value added out of their coal rather than just digging it out of the ground and shipping it out of the province, right? That need to address air pollution in coastal provinces and the shift in energy intensive manufacturing is creating new opportunities for coal-rich provinces in central and western China to monetize their coal resources. And there are a couple of ways that they could think about doing that. So the first is coal by wire, right? If it's a problem to have coal-fired power plants in coastal China because of air pollution, then why don't you just move the power plant to where the coal is, right? Mine-mouth coal prices in China and Xinjiang, $30 a ton. For 6,000 kilocal coal versus delivered coal prices in Guangzhou and Tianjin, $100, north of $100 a ton. That delta is rail, right? It just hits a long way from Xinjiang to the coast. The rail is overloaded. If you go to coal country, you will see miles of semi-trucks just sitting in gridlock traffic because they don't want to pay the $3 for the toll to use the new toll road, waiting to get to where they're going. Very inefficient way to move coal in the country. If you move those coal-fired power plants, or if you just move where the new coal-fired power plants are built, not even the existing assets, away from the coast to the interior, and then you build ultra-high voltage transmission lines to ship that power from coal country to the coast, then you can address the air pollution problem and provide an economic development opportunity, right? That is the plan favored by the State Grid Company of China, which is one of the most politically powerful entities in the country. They have been shopping a roadmap for ultra-high voltage transmission lines for years, and the air pollution crisis is giving them a new argument. The risk to this strategy is predicated on a view that your load is going to remain in coastal China. If instead you move where that energy-intensive investment is occurring elsewhere in the country, you're building a bunch of transmission lines to nowhere, right? If the demand for coal or electricity moves to central China, then those investments make less sense. And some of that's already starting to occur. So this is projected aluminum capacity additions by province. And a huge growth in Xinjiang because you have cheap coal, cheap mine mouth coal. Not a lot of way to get that coal to market today, but you can go build a smelter there and ship the aluminum, which is the value-weight ratio is more favorable. So most of the new aluminum capacity is being built in Xinjiang, right? So that's kind of strategy number 2 if you're a Western province for how you develop your coal resources is just invest in heavy industrial capacity there, and that's what Xinjiang's doing. And then the third is you try to do coal conversion. This is the Xinhua direct coal liquefaction project in Inner Mongolia. There are a number of indirect coal liquefaction projects that are at some stage of development. The really rapid growth has just been more simple coal gasification using Texaco or Shell gas fires for fertilizer, for methanol. That stuff's proliferated. Indeed, many of the new natural gas plants being built in Beijing to replace coal capacity are going to be supplied with syngas produced in Xinjiang or Inner Mongolia or Shanxi and shipped by gas pipeline to CCGTs in Beijing and Tianjin, right? So it's unclear how all of that is going to play out, right? But how successful Xi Jinping is in economic reform and how Western provinces choose to monetize their coal resources are going to have large impacts on Asian coal markets and the prospect for US coal exports as well. If you look at the change just 2012 to 2011 in coal demand by province, blue is increasing coal consumption, green is decreasing coal consumption. Southeast China, net declines in coal demand, flat or slight net declines in coal demand in Northeast China, very rapid coal consumption growth in Western China over the past few years as those provinces pursue some variation of those 3 strategies together. So the outlook for total coal demand in China is relatively unclear, but from Asian coal market standpoint, the outlook for coal consumption in coastal China, I think, is tenuous right now. And that matters a lot for the Asian coal market because the big development in the Asian coal market over the past few years has been the shift in China's coal trade position. So China was a net coal importer as recently as 2005, buying 50 to 80 million tons a year. It swung into a large net export. It was a net export. It swung into a large net import position in 2010, 11 up to 320 million tons of coal imports over net coal imports over the past few years. That 500 million ton swing is a big change in an Asian coal market where total Indonesian exports are 400 million tons and Australian exports are 336 million tons. So what happens to this balance in the years ahead will have a significant impact on coal pricing in the Asian Pacific market. And we're already starting to see that occur. Weaker demand for coal in coastal China has dropped spot prices by almost half over the past year or so, which if you look at the kind of net back pricing of coal from Guangzhou, let's say, to the Powder River Basin, taking some heroic assumptions about rail transport costs, and Bill tomorrow can tell me why all my transport cost assumptions are wrong. But so if we said it was like $30 a ton, which I'm sure you actually can't say for antitrust reasons, but if it was $30 a ton to move coal by rail from Wyoming to the west coast of the US, this is the net back pricing to Wyoming from Guangzhou pricing, right? So you take spot prices at Guangzhou, you apply the VAT, the coastal shipping rate, the dry bulk shipping rate to get it across the Pacific, port charges, estimated port charges in the Pacific Northwest, and then the rail fee. That spread was really, really good in 2000. Chinese coal prices were very high. Dry bulk shipping rates were pretty low. PRB miner might be able to make, $60 a ton selling coal to the Chinese market, to the southern Chinese market. That is still a profitable export opportunity, but that gap has closed considerably over the past few years. And so the change in overall rate of coal demand, and more importantly for Wyoming, the geographic composition of coal demand is going to determine the price and appetite, at least in the Chinese market, not necessarily the Korean or Japanese market for Wyoming coal in the years ahead. Why don't I stop there?
Very good. Questions?
Yep. Trevor, can you speak a little bit to just the efficiency of the Chinese coal mining? I mean, is it from, you take a look at the Powder River Basin processes, I mean, it's extremely efficient, highly mechanized. When you talk about moving the coal west and the people follow, is that just because it's so labor intensive to do the coal mining? Is that why the people are following where the coal?
Why the production would be moving, coal production would be moving west. The coal production isn't really moving so much, it's the demand for coal that's moving west from the coast, right? So to answer your question, the quality of mining in China runs the gamut from extraordinarily dangerous small mines to world-class, 10 million ton a year mines. It's all over the map. Directionally, the quality has improved primarily through consolidation of some of the smaller, less efficient miners into some of the larger companies like Shenhua and China Coal and others. The coal production profile will probably change and move more towards Xinjiang in the years ahead, but the more important question is where the coal demand moves. So do we continue to have coal demand in coastal China that's fed by production in western China, or does that demand, whether it's power generation, heavy industry, or coal chemicals, move closer to the mine mouth? And that appears to be what's happening now. So even if overall coal demand in the country is growing, the geographic allocation of that demand is moving in a way that puts downward pressure on Asian coal market prices.
It would appear in the slides there that once they make up their mind they want to do something, it doesn't take them very long to actually get started doing it. And here, that is probably less rapid. Is that an accurate viewpoint?
Yeah, so I think we have a tendency, based on our own political gridlock here, to kind of look longingly over the Pacific and think, if we were just an autocratic government, we could get it all done. There are some things that the Chinese government has the ability to do quickly and efficiently, and some things that they don't. So, if we think about going back to that 1978 inflection, part of the reason that growth strategy didn't pan out is after they developed the Daqing field in China, which is like 800,000 barrel a day. It was the first elephant field. Chinese leadership decided that all they needed to do was just discover another 12 Daqing fields and become the Saudi Arabia of Asia and use that revenue to buy foreign technology. And the Communist Party is powerful, but they can't will hydrocarbons in the ground where they don't exist. There have been lots of instances of government priorities and objectives not panning out because they were pushing too hard against either market realities or the vested interests of stakeholder groups in China. Here, the biggest risk to Xi Jinping's economic reform agenda is that the stakeholders, the vested interests in those state-owned enterprises are able to overcome his political strength in implementing those reforms. There's a fairly tense battle happening in Beijing right now about the economic reforms that Xi Jinping wants to put in place. Then you have other tensions, like provincial governors who really want to monetize their coal resources versus central government that wants to see a decline in overall coal consumption in the 2030s time horizon. So all of those get litigated through the kind of back channel politics of the Communist Party. But just because you don't have multi-party elections doesn't mean you don't have politics, and China's pretty rich in politics right now.
Hi, Trevor. Okay, sure. I have two questions that are somewhat related. Several years ago, unless things have changed under the new leadership,
there was still price controls on coal, domestically produced coal, domestically electricity pricing, same thing on domestically produced oil and gas and everything else. But I don't think those controls and commodities apply to imports. And the link to that, has that changed under the new leadership?
Yeah, gradually. So in general, upstream prices are liberalized, downstream prices are controlled. So for crude oil, what CNPC and Sinopec can sell their domestically produced crude oil at is indexed to global crude spot prices, right? So there's the domestic production, the international production on crude's the same. Gasoline and diesel prices remain controlled. Now that doesn't mean cheap. It's not like 50 cents a gallon gasoline like in Saudi Arabia that people set fire to with barrels to keep warm. It's $3.50, $4 a gallon. In power, coal prices are almost entirely liberalized now. The power prices are still regulated by NDRC.
Yeah, and where you are along the value chain, certain folks get crunched in terms of the differential. And the second related question to that is because there are no controls, if you will, in terms of pricing on imports, and the fact that the productivity of the use of the money from the Central Bank of China, Export-Import Bank, is that in fact driving part of the investments of China into the United States and Canada in terms of resources to export certain commodities and things back to the mainland?
In general, most acquisitions by Chinese companies in the energy sector are driven by just a balance sheet need to diversify and improve their upstream resource base. So that's certainly true of Sinopec's acreage investments in shale in the U.S. It's true for CNOOC's acquisition of Nexen. Like CNOOC didn't buy Nexen to be able to export oil sands from Alberta to China. CNOOC bought Nexen because they were 95% Chinese in terms of their upstream portfolio, and they want to be an IOC. They want to be a diversified global company, and so they want to diversify their resource base. Where it comes into play is you will occasionally get concessionary capital from China Development Bank or the China Export-Import Bank for a project that could deliver trade flows back to China. So you'll have companies that are arguing they're arguing for the domestic energy security benefits of a particular project in order to get concessionary capital from Chinese policy banks, even though from their corporate standpoint there's not a lot of interest, and they're going to market it wherever the price is highest.
Two more questions, one here.
Hi, Trevor. You mentioned the movement of coal power generation from the East Coast into Central and high voltage transmission, bringing electricity into the coast. I also heard a lot of activity relative to converting that coal into natural gas and then pipelining that, generating power via natural gas within those East Coast cities.
Yeah.
Can you speak about that?
So, current projects are still probably only in the 1 BCF a day range of production. There are projections you could have as much as 6 BCF a day of gasified coal being used for power generation in coastal China by 2020. There's a lot of debate within Chinese policy circles about those projects and whether to give them a green light. There are folks within the government who are trying to promote the development of tight gas and shale gas and CBM that see those coal gasification projects as competition for their pipeline access. So we're going to see some of that for sure in the years ahead, whether it's like 2 BCF a day or 8 BCF a day remains to be seen.
Next question.
Unlike the description you gave of China's market, the status in South Korea and Taiwan and Japan, they're all completely dependent on imports, no domestic supply. Each of them, therefore, South Korea, Japan, Taiwan, has a portfolio of future projections for what they hope will be their mix of LNG, nuclear, coal. Question to you is, what's the effect of the American price signal or the potential for American export on that future planning and mix of energy choices that are made in those 3 developed countries? And before you answer, please accept our thanks. Fantastic job putting together a keynote that had everyone in the room thinking. Thank you very much.
All right, thanks, Bill. So I can't speak to the Korean and Japanese planning process very well. There's a colleague here from JBEC, I think, who can probably speak to it better than I can. I mean, at the margin, right, the changes in the Chinese coal trade balance, to the extent to which they soften Asian coal prices, will indirectly impact the competitiveness of U.S. coal exports. That may not matter at the quantities that you guys are talking about exporting, and for supply diversification reasons, those contractual commitments may occur for reasons other than kind of marginal pricing. But anything that pushes down Asian seaborne coal prices is going to, on the margins, reduce demand for U.S. coal exports.
Trevor, I have one more question.
All right, we're going to make an exception.
Can you hear me?
Yeah.
Great. I'm just wondering, your initial R&D, does that include Chinese-held assets in Africa in terms of industry by sector, i.e. aluminum, cement, etc., or was that exclusively in China?
Only domestic in China. The magnitude of the overseas investment by Chinese companies in industrial production is, it's probably 1% of domestic Chinese assets right now. It's certainly growing. And one of the interesting, while I'm relatively bearish on China as a coal import market, I'm pretty bullish on Southeast Asia, in large part because as the demand for Chinese coal-fired power generation slows down, you have an equipment industry and an EPC industry in China that has been able to turn out 80 gigawatts a year of $600 per installed kilowatt supercritical coal, and they're going to look for a market, right? So you already see, if you're GE or Siemens, you're having a really hard time competing for contracts in Southeast Asia or in Africa because the cost of Chinese coal-fired power gen is basically the Barbie doll effect for coal-fired power plants, right? That scale of Chinese manufacturing is significantly reducing the cost of coal-fired power elsewhere in the world.